Good morning, ladies and gentlemen. It's fantastic to be back with you again for Boutiques on Wednesdays. Great to have you all joining us this morning again. SA equity is a big part of most client portfolios, again offering very attractive valuations. But with global growth slowing and due to high levels of uncertainty, as we all know by now, and local political nonsense, what can clients expect? Joining us this morning to moderate the session and discussion on SA equity, and here to moderate for us is Brendan de Jong, Head of Global Investment Strategy at Portfolio Metrics. Good morning, Brendan. How are you doing?
Good and yourself, Eugene. Good morning.
Very good. Brendan, very great to have you joining us this morning, and thank you for your time. I know it takes a lot of preparation work to have these panel discussions. Maybe before we get going, just by way of introduction, Portfolio Metrics has a comprehensive range of single asset as well as multi-asset investment solutions. I think the audience, and we're all familiar now with Philip Bradford, he's been on Boutiques on Wednesdays frequently, I think we're all using the PMX BCI Dynamic Income Fund by now. If you're not, you should definitely look at it. But Brendan, if you can, maybe just in a minute, you have so much more to offer intermediaries out there other than your single asset funds. Can you maybe, if you will, in 1 minute, just explain to the audience what all you do?
Yes, absolutely. Thank you very much, Eugene. Yeah, so as you mentioned, single asset and multi-asset funds, but we also have a range of model portfolios, both onshore and offshore. But I think really, we're going to talk about our foundational purpose and the reason for why we exist, and that's ultimately to free advisors from distractions so that they can concentrate on the conversations that matter. And that's really what we're trying to do. And we do that by offering, as we say, a very comprehensive investment solution set that's multiplied through really strong technology. So I think that's just the headline, and that took me 15 seconds, Eugene.
Oh, fantastic. And I mean, you've got SA teams as well as international teams. I know you're building your international team as well. And your business won several accolades locally as well as globally. So definitely worth considering. So if you out there and you're looking for advice or help with portfolios, please reach out to Brendan and his team. Brendan, I'm going to hand over to you. There's going to be exciting discussion indeed. So many things happening daily, not weekly or monthly. I know one of the presenters also this morning mentioned, hectic stuff. Need to get back into the office and look at what's going on in the markets. But I'll hand over to you. And again, thank you so much for your time this morning. Looking forward to your discussion.
Thank you very much, Eugene. And yes, we've got a fantastic panel here who I'm going to introduce very briefly, and then we'll get stuck straight in. So we've got Evan Walker from 361 Portfolio Manager, Shane Watkins, Chief Investment Officer from All Weather Capital, Becky Mtetwa, Analyst and Co-Portfolio Manager from Battelier Capital, and then Pierre-Jean Prinsloo, who I'm going to call PJ, who is in the investment team at Centaur Asset Management. All highly regarded and fantastic South African equity managers, but also not only SA equity, but also comprehensive investment solution sets too. So guys, welcome to this panel, and thank you very much for taking the time out for this. And yes, as Eugene says, there's a lot on the go, and so I guess we can get stuck straight into it. And I want to start from the top down because I think it's really important, just given South Africa as an economy and how macro driven I guess it is here. And Evan, I'll start off with you. And I read an article coming out from Bloomberg today where the IMF chief economist was quoted as saying, "We are entering a new era. The global economic system that has operated for the last 80 years is being reset." So I guess this is going to be quite a broad and open question, and we'll dig deeper into it. But how have the US-China tariff wars played out in global markets and investment flows? And what are your thoughts on the longer-term effects or implications of this on the global economy?
Pretty Brendan, thanks guys. Thanks to BCI. Yeah, I mean, interesting times for all of us as we live through these tariff wars. There's no doubt in our minds that we will see second quarter, potentially third quarter recessions coming pretty much around the world. These tariff implications for the likes of the US, a 37 trillion consumer market, really the bellwether of consumption globally. I mean, it's got to have an impact on everyone. We're fortunate in South Africa that we're sitting here. We've got quite a varied variety of stocks on our index. I mean, most of the outperformance this year has really been from the dual listeds and the dollar-based shares we have on our market. I just want to quote you one or two because I think it's interesting, Brendan, just to start off with, just to get a feel for how we've done. I mean, we've got Naspers Process up nearly 10, Microsoft down 13, Richemont up 15, LVMH down 25. We've got our gold shares up nearly 100, Barrick Newmont only up 35, 40, likes of Bidcorps, etc., up 5, Cisco down, 5. So, we've got an interesting dynamic in our markets playing out. And then we've got this global context which we're living in, which is obviously getting a little bit more scary going into second, third quarters. So your question really is the long-term dynamics here. What's going to happen? My sense is that we're going to see, and we have already seen, massive capitulation from the Trump regime in terms of overall tariff structures. I mean, this is just not sustainable. I mean, in the US, we've got 35 million small businesses in the US. I'd say a large percentage of those are reliant on some form of importation, some form of after-sales service. And I'd say that a large portion of that 35 million small businesses in the US have some form of Chinese influence, whether they import plumbing materials, electrical equipment, whatever it is, electronics. There's got to be some impact there. And I'm certainly seeing, big impacts coming through. Just anecdotally, we're seeing it every day as companies are shutting down. We've seen massive fall in freight rates. And basically, Chinese ports have come to a standstill exporting across the world. So we know it's not sustainable. We've seen a bit of a blink from the Trump side. But what we also know is he's probably not going to capitulate and reduce tariffs back to where they were before. So we've got this sort of double whammy that we're going to be going through. And in that environment, companies are going to have to adapt. And that adaptation process is going to take long. Companies don't resurrect and start manufacturing in different jurisdictions or alternate their source requirements overnight. These will take anything up to 24, 36 months for companies to alter the way they do businesses. So in that period of time, we're going to have some hiccups. And we've got to try and ensure that we build portfolios around it. And trying to understand the pure dynamics, what happens in China. We think they'll stimulate heavily in China. They'll obviously try to support that economy the best they've been doing. They'll probably come out and re-stimulate a lot of their GDFR processes. We know that at the front end of renewables and the energy cycle, I mean, they added 255 gigawatts of renewable power in China last year. I mean, that'll probably accelerate this year, just as they're looking for growth. So I think every single country, will become a little bit more isolated in their approach. We'll see it from the Eurozone. We'll see it from pretty much everybody will try onshore and bring where they can back to the local environments. That does create a new world order. I mean, this new world order that we're seeing is probably around that environment, that everyone will start to look at where they can produce stuff locally at an efficient level. And then guys will have to find their feet. But that process is going to be messy, Brendan. We can't sit here and say that it's not going to be messy. It's going to be a messy outlook. And we've got to try to build portfolios that we think can sustain through those environments and protect capital, number one, and then hopefully grow capital, number two. But we're expecting more fallout, and we're expecting certainly by the end of second quarter for central banks to continue cutting substantially. And we think the Fed is behind the curve. It's probably the only thing we do agree with Trump on, is that the Federal Reserve is behind the curve. We've seen the ECB cutting rates aggressively, and they'll bring it down further and hopefully we follow on from that, propelling the sort of global economic growth back into 26 and potentially 27 again. But second quarter, third quarters, I think this year are going to be troublesome, and we've got to build portfolios around that.
Thanks, Evan. That was very comprehensive, and I think the next one for you, Shane, is kind of still keeping it high level before we dig down. I mean, we've seen China engage in a tit for tat kind of tariff war, I guess, and trade war with the US more recently. But they also have potentially another option of currency devaluation, which they have done so in 2015, which resulted in pretty poor performance in global equity markets. What do you think is the risk there that happening? Do you think that that's a realistic utensil that the Chinese will use to buffer that impact of trade tariffs? If yes, like, how do you see that playing out this time around?
So, Brendan, good morning, and good morning to the listeners. I think, Evan's absolutely right in his assessment about what a sort of a seminal change this is. And I think it was Lenin that said, there are decades when nothing happens, and then there are weeks when decades happen. And we are seeing a change in the world order, a world order that has served us since the Second World War. And this is not really, the tariffs in some way are a symptom of this change rather than the change themselves. I mean, for example, the two big things that we are seeing now in terms of a change are a breakdown in a military alliance system. The US dollar's strength has been underpinned by America's military strength, where they've been able to exert influence around the world. And it's these military alliances, and now Trump is threatening to pull out of NATO, defund NATO, not defend Taiwan. I mean, he voted against the Ukraine and supported Russia. So he's disrupting global alliances from a military perspective. And then the other thing that we are seeing is that the cohort of people that have traditionally pulled us out of economic difficulties since the Second World War has been the US consumer. And now with tariffs, the US consumer is not going to be in a position to save the rest of the world. So if you think about it in terms of the military alliance and the kind of maybe the diminishing role of the US consumer in solving our problems, that gives you a sense of where we are now. Your question about whether the Chinese would weaken the currency further, obviously, a weaker currency allows them to absorb some of the tariff barriers. But the reality is that only 15% of Chinese exports go to the United States now. That number has halved over a decade. So China has diversified where they are exporting to. Maybe if you want to say, well, how does all of this geopolitics affect South Africa? In South Africa, we've had three things affecting us almost simultaneously. We've obviously had the tariffs, which have had the net effect of reducing expectations of world growth. We've then also had the potential breakup of the Government of National Unity. And then on top of that, we've had a dispute between the South African government, or perhaps more correctly, the ANC, and the Trump administration. And so those three things have introduced a high level of uncertainty into our market, which have affected both, I guess, forward earnings and maybe the rating of the market itself. So to address them sequentially, I think Evan's right. I think tariffs will remain, but at a lower level than maybe, the initial 50% level that Trump first mooted. So we think that we'll muddle through on the tariff story. I think actually Trump will cave, not China. It's much harder for Trump, who has midterm elections, to kind of brazen this out, in what is still a democracy. Really, I mean, Xi Jinping, he can hold out until the end of time. It's a totalitarian state, really. And I think he's in a better position to take a longer term view. The second thing is, in terms of the GNU, I think our expectation is that the GNU will hold together. We've seen recent polling, which has shown that, the DA in some respects is polling above the ANC now. And that is because the ANC supporters do not support their radical policies. It's strange to see the detachment of the ANC from its own supporter base, and where they implement policies which their own supporters don't believe in. I mean, if you think back to the elections of the 29th of last year, in the week prior to the elections, the ANC was polling at 45. They then threw all their weight behind national health insurance, and they ended up polling at 39. The ANC's commitment to NHI is actually hurting the ANCs themselves. And then the final thing, of course, is what happens with the dispute between the ANC and the US government. And that's kind of really a wild card, because those responses, I think, will be determined almost in an emotional sense by the Trump administration. So we're in a difficult space at the moment. But I think at the same time, we've seen big price moves And our job as fund managers is to say to ourselves, how do we monetize these price moves to the benefit of our investors? And there are definitely opportunities. So volatility brings opportunity. And then in some respects, some companies can even be beneficiaries of this. I actually had a call with Anthony Thunstrom, the CEO of Foschini yesterday, not about trading. I just wanted to understand, from a global sourcing perspective, is this good or bad for them? And his view is that net, as importers of clothing from the East, this is actually a positive for them, because product that might have been going from China or Vietnam to the United States to be sold at TJ Maxx is now available to them and being dumped on the market, and they can actually source more cheaply. So his view of this whole fiasco is that while global growth may be less and SA economic growth may be slightly less, from a sourcing perspective, there's actually a benefit to them. So our job is to find the winners in this uncertainty.
Thanks, Shane. And Becky, I suppose related and referencing some of the stuff that Shane and both Evan as well mentioned, but as a small country on the tip of Africa, we are quite exposed to what is going on a geopolitical basis. But I'd like to understand more specifically in terms of our equity market, which sectors are at risk or most at risk here. And in the context of that is, and I think Shane also alluded to that, which ones or companies themselves may present opportunities to us.
Yeah, I think maybe just to directly answer your question. So if you think about the deteriorating relations between South Africa, so I think the base case pretty much, if you talk to stuff like AGOA as an example, that's most likely not going to be renewed by the end of the year. So that directly impacts our agri sector. Yesterday, there was actually a nice article from the CEO of NAMSA talking about the impact of obviously the export vehicles that we send to the US. I think the number he quoted was about 25,000 cars go to the US, and surprisingly, majority of those are actually European brands. So I think just touching on the previous questions and what's been spoken about is there's going to be an interesting dynamic with regards to where we side or simplistically where South Africa sides with China, as opposed to if you think about what's happened with his approach to tariffs, right? So I think that's the first point I just mentioned about where it directly impacts obviously South Africa. But I think there's plenty of opportunities for us, and I think less so related to obviously the international relations with the US, but more specifically with regards to the GNU instability. I think for us, when we sit here in South Africa, we are a quality-based house. We prefer companies that have quality earnings, predictable earnings. And where we first fish when we look for opportunities, we start at the top where quality is. So we'll buy companies like ShopRite, companies that have continued to deliver credible results, even through a tough backdrop in SA as an example. And we expect them to continue taking market share from their peers because the majority of them are still pretty much distracted by their international operations and their balance sheets are constrained. So I think for us, we start there. But in terms of how we've been managing it from a local perspective, we've been adding to our pretty much our rand hedge exposure. So I'm talking like Raynet as an example, which presents a great opportunity. They've recently sold a huge BCI stake. The discount to NAV sits at around 48%. So there's margin of safety within the valuation. And we'll stick with the companies that we like and we understand. So the Anheuser-Busch, which benefits from a weaker dollar, and essentially the quality businesses like Bidcorp. So I think there's no shortage of opportunities for SA managers to pick stocks. And I think just for the SA specific stuff, there's plenty quality named, and at this point, I think we'd say that there's no reason to pretty much compromise on quality.
Thanks, Becky. PJ, well, I'll invite you an option to add to the macro if you'd like, but I'd like to ask you actually more of I suppose, a philosophical question, and just to understand a little bit better in terms of how you think of portfolio construction and how much top-down plays a role in the way in which you put your portfolio together, and specifically, I mean, as it relates to this as an example.
Yeah, don't want to add too much to the macro comments. There's been some good comments, and I think it's early days. You've seen Trump capitulate a couple of times, and I think bringing to this kind of topic, the SA equity landscape we're a very small producing country, so the immediate first round effects is smaller to some extent. So the opportunity has really been using the volatility to add to names that, for the most part, isn't affected by this. But philosophically, we always focus more bottom up. We know businesses, we know management, we know how they make their money. So it's quite easy in the whole sell down over the last, call it 3 weeks, to go out and buy some of these names, because we know that these businesses won't be affected in the first round, the second round kind of effect. So yeah, we didn't move or change a big macro view and change our portfolio construction just because of it, because we do see a lot of these macro themes being fleeting, and it changes on a dime dependent on the tangerine man's kind of mood. So yeah, we've been focused from a bottom up. SA Inc. Also sold down quite a bit, and there we got some great opportunities. Yeah, so that's, yeah, I think that's, we don't change much because the macro changes, or at least the story around the macro changes quite rapidly.
Thanks, Ev. I'd like to go back to you, and I think if I were to compare the specific mandates of your portfolio, you have the opportunity to have direct offshore equity exposure in there. So, and I think in your benchmark that you have for the equity fund is 70% local equities and 30% global equities. And at the moment, you're sitting at 39%, at least at the end of March. But again, talking portfolio construction, and as you were mentioning, wanting to protect capital and also grow that capital, the decision between locally listed stocks and globally listed stocks, how do you look at that from an opportunistic basis, and how does that sort of play out in your positioning in the portfolio?
Yeah, thanks, Brendan. I mean, two very separate portfolios. Obviously, the SA equity and the equity where you can take the 45 offshore becomes a slightly different approach, managing around a benchmark locally versus an international benchmark, which is so much more comprehensive. Again, it's around just finding the opportunity set that best aligns ourselves with what we're seeing on the international stage. I mean, the first thing we did on the offshore basis going into the beginning of the into Trump, when we saw the escalation, and the big delta for us was when he hit aluminium and steel with 25% duties or tariffs. And those weren't reprieve. We just said there's absolutely no sense to this, and he could hit further product lines coming forward. What we did initially is we switched most of our product-related businesses internationally into services. And we started by just saying we've got no real outlook for products over the next 2 to 3 years. We just got no idea. So, we took a view internationally that, we wouldn't own product-related businesses. We wouldn't own an Apple, etc. And we bought the likes of a Netflix, for instance, where we thought, on a service-related element, those would do better in an environment where products would obviously get hit with tariffs, which we just couldn't forecast. So again, it's about moving, to environments and business sectors that we think we can withstand. The other commentators have likewise said, moving to environments that we think we can withstand impacts of these tariffs, both domestically in the South African environment. We've done similar. We've obviously strengthened our defensive capabilities in the portfolio, a lot more ANAs, more, obviously less on the SA Inc. side, although, we've seen good results, first quarter results from Standard Bank last night, up 10%, very good numbers. We're not going to shy away from buying South African businesses where we think they can still do very well and they're well diversified. But again, on an international basis, it's been a lot smarter now, having to think about where we really can make a difference, and number two, where we can really protect capital. And I think for now, the stance is going to be basically on a holistic view, is to buy more services, whether it's more banking operations, but buy more service-orientated businesses versus buying more product-related, businesses in an environment where we're just not going to, number one, understand, the margin impacts, and number two, the consumer impacts or demand impacts going forward, where there's just so much uncertainty. There's going to be impacts across services as well, as we know, if GDP falters, but we just think the impact on margins is going to be far less severe on service-related businesses than product-related businesses.
Thanks, Shane. If you can just give us a feel as to what you're doing in your portfolios, and particularly when it comes to looking at defensive stocks, diversifying revenue streams, etc., as it relates to the broader economic environment at the moment? How are you guys positioning at the moment? You're on mute.
I just want to come back to what happened, with the announcement of the Trump tariffs at the beginning of April. And the market kind of went into free fall on Thursday, the 3rd, and Friday, the 4th, as we know. And over the weekend, I wrote a note to my fund managers and analysts, and I said to them, I've been in financial markets for 30 years. I've seen numerous crises, I guess, starting with the crash of 87, then the Asian financial crisis of 97, 98, the tech crisis, early 2000s, the global financial crisis, leading up to more recent things, Brexit, COVID, and so on. And I said the one thing that you've got to understand is that we can never see what is the thing that will end the crisis, but eventually the crisis does end. And so if we focus too much on how are we going to fix this problem, or how can this problem be fixed, or what is the solution, it obscures the opportunity that is embedded in the crisis. And so when the markets opened on Monday the 7th, we were actually buyers of the market. And I mean, it's unbelievable to think that on that day, the NASDAQ traded, I think, in like a 17% range. It was down 7 and then ended up 12. I mean, we've had some extraordinary volatility. And I think we shouldn't say, how are we going to get through this? We should assume we will get through this and focus on the bottom-up opportunities, as Evan said. We don't know what Trump might do, and we shouldn't second guess him, and maybe Trump doesn't know what Trump's going to do. So we should just say, let's assume that in time this crisis will be resolved, and how can we take advantage of this volatility for our customers? So I think that is our first point of departure. I think we've also got to recognize that, we've had, I guess, 15 years where money has been flowing out of the rest of the world into the United States. And what you can see is that the US dollar during the global financial crisis, the DXY, was about 70. And it went all the way from 70 to 110. That's the extent to which the US dollar appreciated. That's because of inflows into the United States. At the same time, the US percent of global market cap went from 45% to 65%. In other words, the aggregate value of US companies used to be 45% of the global market cap, is now 65%. So money has left the rest of the world and gone to the United States. That process is now reversing, right? And I think what Trump has done is triggered an irreversible outflow from the United States. That's why we're seeing a weaker US dollar, higher US Treasury yields, and so on. But that money has got to go somewhere else. And part of it is going to come into emerging markets, and South Africa is one of the emerging markets. And I think, so that's our opportunity. And so to get back to what are we seeing bottom up? Well, I mean, I 100% agree on the Renette story. I think it's crazy that a business where over half of the market cap is cash trades at such a big discount. And then I think SA banks, Evan and I have been trading SA banks since the mid-90s, and he'll confirm this. If you can buy a bank below book value and you're patient, you'll make money, right? You don't know how long it's going to take, and you don't know what's going to be the catalyst that will allow you to make money. But if you buy a solvent bank for less than book value, you're going to make a ton of money in time. And ABSA got down below 160 Rand. I mean, that was trading at a 20% discount to book value. It's clearly not, let's say, the highest quality bank, but I think they've now got a competent CEO, and it's not a bad bank. And you're buying it for 20%. If they liquidated the bank on that day, you would have got a 20% uplift in your cash, in your capital, right? So we are looking for those kind of opportunities. And I think SA banks are a good place to be. Both ABSA and Nedbank trade at discounts to book value. And I think if you buy those situations now and you're patient, with 100 years of history, you can see that you'll make money.
Thanks, Shane. PJ, I think gold stocks and the weighting of that in the South African equity market is fairly large. I think Gold Fields, Harmony, Anglo, almost 11% at the end of March. It's quite extraordinary. So your positioning there and your justifications for it.
Yeah, like I said, philosophically, we are bottom up kind of shop, and we're always tilted towards businesses that create value over time. So dynamic value creators, as we call it. And for that reason, we've always kind of underweighted resources, and specifically gold. I mean, it's much easier to understand the intrinsic value of a business that sells a good or a service with this actual underlying strong demand. Whereas selling gold has very little utility in the world, and for the most part, goes and sits in vaults. So we don't own any gold, and over the long term, it's actually been a great position to be in, except for the last probably 2 years. If you pull up a chart of Gold Fields, it's done nothing for 20 years, and then even tripling over the last 2 or 3 years is still quite a bit behind the overall all share. So yeah, the change in gold price has been quite rapid, and it's kind of been our pain trade for the year. But yeah, we've always found that being reactive to these kind of sharp moves is also not the best, and often kind of results in you being late to the trade and actually sitting on the downward trend. And then on top of it, gold shares or gold companies, it's impossible to control costs, and there's this constant cost creep as well. So they do decrease in value over the long term. Yeah, and for that reason, we've kind of stayed away from those and preferred businesses that actually do grow in value over time.
Thanks.
Differ slightly there, Brendan. I differ slightly there. I mean, gold has been the physical gold's been the best performing asset class in the world over most time frames now. I think I must pull that chart. I think it's beaten the S&P over just about every period going back 100 years. So I've got to disagree slightly.
And gold shares?
And we think, well, not all gold shares, but certainly if you take Gold Fields 500% return over 5 years, it's made up for a lot of its lackluster performance in the prior years. But I think you got to look at the environment we're in. And funny enough, gold's in a bit of it's in obviously this great environment currently where people don't want to hold dollars. They're looking for an alternate asset class. And you've also now got the leverage that costs are coming down. So, I mean, a lot of these gold companies are seeing, i.e., their internal oil costs falling, their cost of production falling, okay, because most of their cost of production is in dollar terms, and they're seeing the gold price rising. So there's quite a lot of leverage in these gold companies currently. And yeah, it is 15% of the index now. It's a scary number, Brendan. But I mean, these guys will pump a lot and they're cheap. I mean, our gold companies are cheap. At spot, they're on 5-6 times earnings versus international gold companies on 15 to 20 times. So, you know, this could still be some legs in this gold price going forward, given this context of where we're seeing international trade settle, and we've still got 90 days of tariffs before there's any reprieve on those. So yeah, it's going to be an interesting dynamic to see what happens to that after for gold.
Thanks, Shane. I see you've been patiently holding your hand up there, and I'll give you an opportunity, and then I'll get to you, Becky, afterwards. Shane.
Yeah, so Brendan, you know, I think the one thing about being an investor is you have to be pragmatic. And I think if you have a very evangelical view about any particular company or sector, there's going to be times when you're wrong. Now, where I agree with PJ is that in general, gold mines spend 100 Rand drilling a giant hole in the ground, and over time they take out 90 Rand. They just never earn their cost of capital, right? Never, ever. However, in this current environment, there are two issues that you need to take into account. The one is the issue that Evan raised, which is that there's insatiable demand for gold by central banks because of the declining US dollar and the lack of faith in holding the US dollar or holding treasuries. And that money is getting channeled into gold. and the Indian central bank and the Chinese central bank and the Saudi central bank are all buying gold, and that is not going to stop. Without question, demand for physical gold is going to continue and probably rise. So that's the one thing you need to think about. And then the other thing you need to think about is that what you mentioned, Brendan, is that the gold sector is now 12 or 13% of the market. If you add the PGM sector and maybe the potential upweighting of Amplats when it gets unbundled, gold and platinum are going to be almost a fifth of our market. And everyone is going to be underweight. And when people are underweight an asset that is going up, it is a huge and increasing problem for them. So our view is that most of the time, you wouldn't want to own gold shares. But in this environment, I think you would. I think this is the exact environment and probably one of the only environments that you do want to own gold. And I think if you don't, I think you're going to face a world of pain.
Thanks, Becky.
I was going to say, like, if I could just chip in on just an opportunity, I guess we see on the gold side, and it's indirectly an opportunity. So I agree with a lot of what PJ said, and it's been one of those pain trades for us. But it's one of the opportunities we see as an example is like African rainbow minerals. So African rainbow minerals are diversified miners, predominantly exposed to iron ore, manganese, and PGMs. But simplistically, what we're interested in is they've got a 12% stake in Harmony Gold. That's essentially about 60% of their market cap today. And if you account for the substantial cash in the balance sheet, that's about 90% of its enterprise value. So simplistically, all we're saying is that the market's attributing very minimal value to the operating assets, or alternatively, they're putting a hefty discount on the Harmony stake, which is very plausible for a number of reasons, and we can talk about that. But that's one opportunity. We're basically interacting with management, and they finally, I think, have been warming up with the idea of exploring some opportunities as to show that value for that stake, because the market essentially is not rewarding them for it.
Yeah, I kind of agree with you, but on the other hand, I think the one thing that I've learned is that when you buy a share, you must think who else is going to buy it after you have bought it. And does the share have broad appeal? And African Rainbow Minerals does not have broad appeal. People don't like management. They don't like the story. And if you believe in gold, you may as well just go buy Harmony. So I agree it's cheap, but it's hard for me to see that, let's say, large, credible fund managers are going to go and buy that. I think it's always going to be a niche play. And we always think when we buy a share, we say to ourselves, who are the people that will buy it after us? Because ultimately we need to sell it. And if you cannot identify a large quality group of guys that may want to buy the share after you, then you're probably not going to make a lot of money out of that share.
Take your point.
Thanks. PJ, I'll give you a minute or two, but also to respond, but then also, I guess I'd like to move on to PGMs and just discuss sort of supply demand dynamics. They're also a reasonably sized part of the index too. So PJ?
Yeah, just on the goals, I mean, we've seen central banks been buying, but incremental buying hasn't been materially higher year to date. So I think it's quite a bit of investor flows. And obviously this is a bit of a TINA trade because you don't want to own US treasuries, US dollars, or US equities. So why do you go and hide it? And maybe gold is one of those things where you can go and hide. But that's for the time being. So, and those kind of things turn on a dime. I think I'd take us back to the 2020, 2021 when rhodium spiked massively and we couldn't understand the move, and we didn't buy PGMs at the top, but it's been a very painful ride down for a lot of those guys that did. So just being that reactive, again, we don't own it. And then also we benchmark agnostic. So I know there's a lot of managers gonna own it because it's in the benchmark, and for that we just won't own it just because it's in the benchmark. So what's your other question, Brendan?
Well, look, I wanted to get into the PGM stocks and the broader environment there, supply demand dynamics.
Brendan,
Yeah.
I can't help noticing that while we're talking about PGMs, Aspen's down 31% this morning. And I think this is kind of it deserves some discussion and debate. because this is a company where we've never trusted the management, and we have always thought it was a poor quality operation. They've built themselves as a pharmaceutical manufacturer, and they're more like a Coke bottler. They take all the fancy stuff from sophisticated pharmaceutical companies and package it for them. And I really think today is kind of a day of chickens coming home to roost. But I'd be very keen to get the opinion of the other panelists.
Yeah, sure. I mean, anybody, Evan?
Yeah, I mean, unfortunately, I own a bit. I mean, I've known Steven Sard since 1998. I mean, he's built a 57 billion rand business after today. We probably have listened to him and taken his passion for the business over the fundamentals. I do agree with Shane. It's not a high quality business. It's a 13%, ROE business. I think it's just been his precedented passion for growing the business. That's probably, we haven't got a lot, which unfortunately, specific in the SA equity, we're very underweight, but we have got a tiny bit, but we haven't got an on-weight position there. So that's nice on a day like this when it's down 30 for our unit holders. But again, it's actually a shame, that I think they've got a platform. I think they've got a good platform. I think they could do a lot with that platform. I just think they're in an environment where that platform doesn't allow them to obviously get the returns that the market's implying. And they've lost a lot of credibility around this platform, and specifically, their vaccine growth, which was and filling up that product line. So again, this is going to take a long time for management to restore any credibility after probably 2 years now of a lot of promises. Shane, I mean, they've made a lot of promises to us in terms of filling those facilities, those vaccine facilities, and this is very disappointing. So I think it's going to take a long time before they build credibility back up in the SA market.
Cool, thanks. Look, I think we've got 4 minutes left, so I'd just like to ask one more question, and then I suppose we can close out. And I guess this comes to some of the opportunities, Becky, that you were mentioning, and PJ as well. I suppose the opportunity set that you guys are seeing in a little bit further down the market cap spectrum, I suppose. But looking at the South African economy, which has been struggling for growth for quite some time, and the broader economic environment looking to slow down for obvious reasons, is the timing of looking for opportunities in those more undercovered regions the best of times right now, or is it just basically a risk that you need to take on for the valuation opportunity? Becky, I'll start with you.
Okay, just a quick one. So I think for us, like, small caps have tended to be a good source of alpha for our funds. It makes up about 10% of our funds right now. We've been reducing that. And then the simple reason to answer your question is, as investors want to be more nimble, capital will continue moving towards the top 40 and the more liquid names. That's just the fact of the matter. And I guess the other point to mention is that essentially that will produce some opportunities the day private equity potentially comes along. I've got a long list of small cap companies that we think shouldn't be listed, and because there's huge insiders who own pretty much half of the businesses. They're sitting on net cash, highly cash generative with debt. So when private equity comes along, but essentially that's patient money. So I think that's my 2 points I'd mention.
PJ?
Yeah, I mean, we own quite a bit of small caps, and that's just because of the size of the fund. We 700 million rand, the SA equity fund, and we do see quite strong opportunities. For example, the education stocks, it's small caps, but I mean, it's probably one of the most resilient growing industries in South Africa. So we own Advitech and Stadio there. And if you compare, like, a lot of guys are saying, let's buy AB InBev for defensive exposure, but you buy it at 16 times and their volume's going backwards. And you have this whole structural trend where younger people aren't drinking anymore, versus buying a Advitech, which is consistently delivered volume growth at a 14 times. So we do think that we have a unique ability because of the fund size, but also the reach we have in meeting with management, competitors, and so on, to kind of continue to be quite overweight in small caps. And even recently in the sell down, when a lot of people have kind of sold it down, we've added to small caps as well.
Great. Look, I mean, Ev, Shane, I don't know if you guys have anything there, but I guess In closing, as well, I'll give you guys a bit of an opportunity to respond to this, but really, Shane, as you kind of mentioned, in terms of great uncertainty comes great opportunity too, and I'll leave you guys a bit of a time there to give your overall assessment of this. You've alluded to some of it, but just to wrap it up in terms of looking through the cycle, long term, etc. So, Ev, I'll start with you.
Yeah, Brendan, thanks. I think, you've got to be very conscious in this environment not to get too clever. So I think you've got to ensure that your portfolio, because this is other people's pension money, has got a big slug of defensive stocks, the Bidcorps, the Anheuses, the BTIs, businesses that are going to be around for the next 3 to 5 years. If this Trump transition ends up by being more messy than we think it's. So I think you've got to be very conscious, a number one starting point of what you own in the portfolio. Then, like Shane rightly says, I think you've got to take opportunity sets on big down days, buy more banks if they're trading on dividend yields higher than the PEs, which we've seen of late, because these businesses will be around in the next 5 years. The ABSAs, the Nedbanks, Standard Banks, etc. So I think you've got to be flexible in this environment. I think you've got to own good businesses, a preference for quality. Likewise, we see in the Aspens today, it's not a quality business, as we know. You've got to have more ShopRites. You've got to have the quality in your portfolio. And then you've got to take it. You've always got to take a bit of risk. That's our job, because that's our job to take some risk. But I think you've got to take risk on down days in good businesses that we know have got an outcome, rather than taking risk in rubbish that we just know there's no outcome. So for us, that's the process now. Stay with what we've got. Have a defensive allocation to the portfolio. Ensure that we protect capital and grow it. Done an unbelievable job in the last 5 years of muddling through all these cycles, in the last 15 years, in fact, muddling through all these cycles and getting through them. And I think that's a stance for us, certainly for the next 9 months, until we see some capitulation from Trump. We then might moderate, we might sell down our goals, we might take up more South African cyclicals, etc., in the portfolio. But I think for now, we've had unbelievable returns out of SA equity. I mean, as I said early on in the discussion, our stocks here locally, our rand hedges specifically, have blown the lights out of the international competitors, absolutely destroyed them, on that basis. And I think that's been great for our SA equity managers. But in terms of that context, we also need to ensure that we protect these capital going forward.
Shane, 2 minutes, please.
Yeah, sure. So, I 100% agree with what Evan said in terms of sticking with quality. I don't know if any of the panelists or listeners play poker, but in 7-card stud, the best hand you can start with is 2 aces down. And with the best possible hand you can start with, your win ratio is still only 80%. So what I'm getting at is that you lose 20% of the time with the best start you can ever have. And so we never have like an all-in bet. I think we build a diversified portfolio of high-quality shares in a careful and considered way. Then just coming back to what JP was saying on the education sector, I do agree with him on his assessment. And I think we look for places where private companies can step in where the government is doing a bad job. Now, UNISA used to be the largest distance learning university in the world. And, for various reasons, they've almost utterly destroyed that organization, and the private sector has stepped into that space. So I think there are opportunities in South Africa where the private sector can monetize the government's inefficiency.
Thanks, Shane. That time has gone by really, really fast, and we've already run over time. So apologies there, Eugene. I don't know if you want to do a little close out here.
Yeah, Brendan, thank you so much for running the session. I think it's been massively interesting. All is not lost, most definitely. Still great opportunities out there. As long as you place yourself in the hands of good experts that are nimble enough to navigate these markets, as we've seen this morning. Evan, thank you so much. Shane, Becky, PJ, Brendan, really great to have you all with us this morning. I know your time is precious. Things are hectic. We'll let you get back to your desks and see where the next best thing lies. Brendan, again, thank you for your time in preparing for the session. Quick reminder to our audience, next week, Wednesday, we've got Blue Alpha and Portfolio Metrics. Again, as I mentioned this morning, Looking forward to seeing you all again next week, Wednesday, the 30th of April, where we continue our discussions on the markets and where the opportunities sit. Gents, thank you. Have a fantastic week further.